Hello and welcome to this update for the Amati UK listed smaller companies fund for the year 2026 to date, and broadly from the beginning of the year up to the end of April is what we're going to be talking about. This has been very much a stop-start year, really, and a year with many twists and turns already, quite a dramatic period for markets and politics over the past 4 months. Actually, January began really with quite a strong run, and there was the market was pretty quick to have optimism begin to reappear after quite a tough 5-year period. It really, I think most of us market participants were feeling like the market was going to get more of a spring in its step, and we had many reasons to be pretty optimistic about what was going to happen in 2026. And the other characteristic of January was that there was a huge run in gold and silver, which was all over the headlines. I don't know if you remember back in January, it probably got to the point where even your taxi drives or your bus journeys were going to sort of feature conversations about gold and silver. And that really peaked right at the end of January, and we saw a gold price of about $5,500 an ounce, something that was really unthinkable 12 months before that. And of course, that had major implications for some of the stocks, and some of these gold and silver stocks. There's not many in London in UK small cap, but there are some, and they were running very hard. And then in February, we had the gold price peak, and there was a dramatic sell-off over one Friday, I think it was. I remember coming back from London, and the gold price suddenly fell by 10 or 15%, and it was one of those very sharp sell-offs, which tends to characterize markets at turning points. And the gold price has remained strong, but it's not reapproached that peak from end of January since then. And then in February, we had what is now often referred to as SaaSmageddon. And SaaS refers to software as a service companies, so really good, decent software businesses. And really, all of a sudden, the market decided that AI was a massive threat to all software businesses, and they all sold off hard. And that definitely impacted us. The software companies in the UK market are really staple investments for what we call quality growth investors. Companies that grow over the long run, have got very distinctive propositions, can gain market share, tend to have good pricing power, etc. And that meant that that was a strong feature of February and also March, and in that corner of the market. And then towards the end of February, we then had the war in America's invasion and Israel's invasion of Iran happening, war breaking out. And this was in some ways quite a shocking event for all market participants. One could have said, well, were there warning signs there? I don't think it was. Well, there were clear warning signs, because the American buildup of troops in the Gulf was pretty incredible. And there's a rule of thumb with military build-ups. You never get a military build-up beyond a certain level of size, number of troops, number of boats, amount of equipment. I've never seen that happen without war breaking out. It was when Russia invaded Ukraine. It was exactly the same massive build-up of military, followed by war. The time I remember that happened previously was the Iraq War in 2003. Massive build-up of troops, lots of denial about is war going to break out or not, and of course it does. So yes, there were some warning shots, but it still felt pretty shocking in many ways that would happen. And then that led to the closure of the Strait of Hormuz, which everyone's been talking about since, and it dominates the headlines most days since then. Is the strait going to open? And I think, Gregor, you've been counting up the number of times, the number of peace declarations we've had since the war broke out, and I think we got to around 20 now. Tweets coming out late at night saying, "Oh, peace is about to break out," and it feels like whenever the market's about to react negatively, we get a peace declaration from Trump, mostly, never really from Iran. And this is it's confusing. It's the military people who speak about it say there's no easy end in sight. It feels like we need to prepare for the strait to be shut for quite some time. Who knows? The twists and turns of this dominate every day. And then, of course, the final event we've had really that's impacted our markets has been the May elections, a little bit after the period, but we should cover them because it's relevant. And we've had a sort of steadily, uncomfortably high government bond price in the UK for all of this period, and it's been rising. And one thing that we look at quite a bit is the spread, the 10-year government bond spread between the UK and other markets. And let's take the US market, where for most of last year, the spread was about 25 basis points. Today that spread is more like 60 basis points, so it's more than doubled. And this is very painful for a government that's borrowing massive amounts of money, continually needing to refinance a huge amount of debt, has no clear spending disciplines coming in. All the initiatives that they were thinking about last year to cut spending essentially got vetoed by the backbenchers. And this is, the bond market obviously sees all of this coming. And the last thing the bond market really wants is a new prime minister from the left of the Labour Party who will come in sort of saying, well, why do we need to worry about bond markets? And then a few weeks later, they'll find out why they need to worry about bond markets. And, do we have to go through all of that again? I don't know. It's happened, obviously, in recent memory with the Liz Truss government, which didn't last very long. Are we looking at that happening again? It's not a foregone conclusion by any means, but the bond market is already applying a lot of pressure to the government to be sensible. So yeah, Gregor, why don't you come in at this point and just sort of talk about what's contributed and what happened performance-wise?
Sure. So to summarise all of that, what did that mean for the fund? Well, to the end of April, we were up 1.3%, which was a little ahead of the benchmark, which was flat, which gives us some comfort that the fund can cope with these sort of gyrations that we've talked about. And to drill down a bit further into that, we've always been believers in energy, and that energy plays an important part of the mix. So it's no surprise that the energy stocks within the fund, Serica Energy and Ashtead Technologies in particular, had a good first part of the year. Greatland Resources, which is our gold mining company, which has been a fantastic performer all the way through, continued to deliver, as did Hochschild, the silver miner, both benefiting from the huge rise in underlying commodity prices, and both playing an important part. Out with the resources sectors, we saw sort of recovery in some of the really oversold names of 2025. The train line, big tech, AJ Bell, all sort of mounted sort of spirited recoveries, and as we'll go into a bit later on, all justifiably could have a lot further to go. And another topic that dominates the market is takeover activity, and Kitwave was one company that was acquired during the period. On the negatives, taken away from the performance, the house builders, of course. The house builders have been dreadfully unlucky in that we all expected rates to start coming down and for the mortgage market to start picking up this year. I think the war and the inflationary shock that comes with the higher oil price really sets that back. Rate expectations perhaps are going in the other direction, and that really slows down housing activity. So MJ Gleeson, who make affordable homes and develop land, that's been quite a setback to them. And as Paul's mentioned, SaaSmageddon, this idea that AI is going to replace software companies, which seems fanciful in the case of many of the portfolio companies who perform critical roles for some of the biggest companies in the world, but they have had a difficult first part of the year. So Alpha Financial, Boku, Kainos, GB Group have all lost a bit of ground over the period. So what trades have we made during the time? Well, we'll go into these in a little bit more detail, but Paragon Bank, which is a buy-to-let specialist bank, and Quilter have helped sort of bulk up the financial sector. U Group, which we'll talk about later, and SRT have all been brought into the fund. And the main sales, as I said, Kitwave was bid for, and that's left the market now. Impacts is an environmental and ESG fund manager, a very competitive field, so we exited that, and we've also reduced our exposure to the real estate sector, coming out of CLS and of Granger. So where does that leave the shape of the portfolio as we go into the second quarter in the summer? Well, there's 40 holdings. The median market cap is a short 500 million. And the reason for that is that many of the sort of larger names in our universe are still on, you know, huge discounts to their historic rating, and of course their international peers come across. Sector-wise, we are deliberately overweight industrials, which of course includes defence. Equally, we're overweight technology, which we've increased from about 19% to 24%, although it's important to recognise that's quite a broad church of services and provision of software to, and quite an international customer list. Utilities, we have introduced U Group, so that's brought that sector from 3% up to 7%. And energy, as I said, which includes the oil and gas constituents, that's doubled from 3% up to 6%. Real estate, we've brought that down, having disposed of a couple of the holdings. And basic materials, we've taken some useful profits from the gold and silver miners, and that's come down from 9% to 3%, where it currently stands. Where do the companies derive their revenue? Well, it's important to note that, you know, it's about 60-40 split between the UK and the rest of the world. So we're not wholly dependent on the UK economy turning a corner, although it would be helpful if when UK rates do start to come down. We do think a lot of these companies will be immediate beneficiaries. And valuation, and this is really stark because the valuation of the fund in aggregate is now on 11 times earnings, which is less than half where it was at the peak, and also less than half where some of our international peers currently trade.
Yeah, thanks, Gregor. And thought it'd be interesting just to talk about what are the factors shaping the portfolio at the moment, and how do we see that? So I'd say that we're pretty contrarian on the software sector, and we think this big sell-off in these high-quality software companies is an opportunity in the listed markets. One analyst we know, who is a strategist, reckons that software companies listed in the UK are on average at a 26% discount to those in the US and an 18% discount to European markets. We tend not to really sort of think about that side of it, but what we do look at is the way that the shares have tracked versus the earnings revisions to a company. So I'm going to put up a few slides as I talk through some of the companies we're involved with, really that show you how the forecast revisions have taken place over either 2 or 5 years, depending on which gives the most meaningful data. And we don't have earnings revisions always for 5 years. And that shows you how the revisions track against the share price performance. So let's start with Boku, because Boku is one of our top 10 holdings. It's one of our favorite. We're calling it a software company here. It's really a payments business, but it's a technology-led integrator of payment systems, particularly focusing on non-card payments. So all the methods of paying except for credit cards. And its customer base is all of the major digital vendors globally, and most of these are American, but they're not all. So these are companies like, you know, Amazon, Alphabet, Apple, Netflix, Spotify, those kind of companies, Sony, selling a lot of digital content, and they will be doing the payments in all kinds of markets outside of their home markets for those companies where they don't want to have to integrate tens and or even hundreds of different payment methods. So Boku does that. And this graph here, you just see how earnings revisions have been pretty spectacular, or earnings growth has been pretty spectacular over the last 5 years. Admittedly, this is coming from a very low base, so we got relatively big numbers. And the company's been derating over that time. Shares have hardly gone anywhere. They had gone up 50% through last year, and they've gone all the way back down. We remain really optimistic about this business. And this is representative, really, of a number of companies similar of a number of UK software companies. Quick reference to GB Group. This is also a relatively large holding. Was a very consistent grower for many years up to 2021. And then its earnings kind of flattened off and even fell a bit. We think it's now commercially in the best shape it's been in for quite a few years. But you can see here the share price, the rating of the shares is at a massive discount to any point in recent history. And we think there's a big catch-up move for this company just to kind of catch up with where its earnings are. And as earnings revision starts to move more positively in this company, we think there should be a very good share price response to come from that. Alpha Financial, this is one we increased a bit during the period. Similar story, big earnings growth, not much in the way of share price moves as yet. And just maybe a word about why are we confident about software companies and what is the dynamic that we're expecting with AI? Is AI going to come along and wipe all of these companies out? We really don't think so. But some software companies will be at risk from AI, and those if you're in very competitive, fairly generic markets that don't require a lot of proprietary data, that's more of a problem. But if you are in markets which require very deep domain expertise, so take GB Group, it's doing fraud and identity. Those are areas where if the customers make mistakes, it's incredibly expensive. They require very good data and the most reliable and best data sources. They require consistency, and mistakes outweigh the cost of the software by a big margin. And GB Group happens to be the global leader, so they can spend more on developing these systems than really any of their rivals can. So we think they're going to get back into a good position. So there's certain characteristics we need to be careful to look for. You don't want just fairly plain vanilla generic software companies. If you're just devising like a bit of schedule, kind of a new calendar or some HR software or something which could be fairly easily replicated and doesn't require huge domain expertise, that's more vulnerable. Also think we're kind of pondering the possibility that AI, like every kind of technology cycle, goes through this wonderment phase that we went through last year and peaked in maybe February, through to a kind of easing off of that wonderment, and then even to a kind of disillusionment phase when valuations kind of get real and people understand exactly what the technology means and how it's going to be used. And AI is not a kind of solve everything wonder technology. It's got all kinds of issues. And by AI, I'm talking about LLMs rather than machine learning. Machine learning's been around for decades. Well, not decades, but let's say 10 to 15 years. It was the hot topic prior to AI based on LLMs coming in. And machine learning is, all these companies are well adapted to it and they're all expert at it. LLMs, large language models, have very particular characteristics, and for some of them very frustrating. And they are incredible tools for increasing productivity amongst people who are already fairly expert. They're not great tools for people to dabble with who don't know anything about software. So we've already heard stories about companies. Somebody comes along, chief executive comes in and says, "Oh, this is easy," and writes a bit of code to do something or other, and then finds a few days later they've been hacked because the code that LLM downloaded was malicious code that had been planted online by some clever people who deliberately to get picked up by AI for use by people who didn't really know what they were doing. So I think we've probably seen peak SaaSmageddon is kind of our view, and the market should hopefully take a more realistic view as the earnings growth. The key will be the earnings growth, and if we're wrong, it'll be the earnings growth that shows we're wrong. Then we sold down our resources, as Gregor has already mentioned. Greatland Resources is really our one miner at the moment, and we're looking at a couple of other potentials. But in terms of the gold and silver run, we had good exposure to it. We locked in our profits in late January, February. But Greatland Greatland Resources is one of the best gold miners I've ever seen in the London market. It's really been a phenomenal story. It's been probably our best investment of the last 18 months. And we think it's got further to go. So we've kept it. We've trimmed it as a position, but we've kept it as a significant holding in the fund. Defence is obviously an emerging theme, and it's shaping a lot of our thinking. We've got Chemring and Kinetic, and we added a holding in period called SRT, which Gregor mentioned briefly. It's a company we've known for 25 years. It's been gradually maturing for 25 years, and it's now finds itself as really one of, possibly, I'd say, the leading vendor of civil defence systems to coast guards and fisheries, and any government entity that wants to monitor what's going on in their coastlines out to about 50 miles or further, that wants to do it with all of the best technology in the most efficient and practical way possible. SRT has become the go-to company for that pretty much globally, and they're the only company who've signed multi-$100 million contracts with quite a number of different countries now, supported by the UK Export Agency, to provide these systems. They provide the command and control software. They integrate their own AIS technology, and they integrate lots of third-party, radar systems, drone systems, and other things into their command and control center. And I think it's one of the fastest growing companies in the UK right now. It's a bit of a hidden gem on the market. It's really turned consistently profitable in the last 12 months. And we think its earnings trajectory is going to be very strong from here. So we added that as a holding in a placing they did. We've reduced our UK interest rate exposure. This was really in response to predicting that the bond yields were going to come under pressure as a result of the electoral worries, the May elections, and the political consequences of that in the UK. It does mean that there's a fairly cyclical part of the UK market, which is going to find going heavier in the coming few months. So we've reduced our exposure to that. Clearly that's a cyclical end of the market. It will have its day. We've got to keep our eyes attuned for when that does start to bounce back, but we think that's been delayed. In financials, we really just rotated our exposure here a little bit, as Gregor's already mentioned the names, so I won't dwell on those. But what maybe is worth saying, just to flick through some of these companies, if we look at like Mortgage Advice Bureau, it's coming up here on the slide. You can see there's a strong theme again of significant earnings growth over a 5-year period, absolutely not reflected in the share price. You can see that also in AJ Bell, even more so possibly, but the big derating in the PE, significant earnings growth, very consistent earnings growth, not much progress in the shares. Paragon, another name we added, the shares trailing well behind the earnings growth, which has been very consistent over 5 years. So that's a common theme across the portfolio. Almost every one we look at is going to feel like that. In terms of our energy exposure, we increased it a little bit, increased through performance as well through the period. And we added in this holding called U Group, and you can see here again, I've only put two years history in here because over 3 years the earnings growth has just been phenomenal as the company went from making almost no money to making really a lot of money. So I've only included 2 years. You can see really big earnings growth even over that period. Very strong organic growth in this business, and the shares so far haven't reflected it. So we're pretty excited about what can come from that holding. And it's a quasi energy stock because it benefits from higher energy prices, and it benefits from our amazing ability in the UK to completely ignore the consequences of having very high energy costs, which is resulting in significant deindustrialization in the UK. We've almost had a deindustrialization policy, and we're kind of just saying, well, okay, we can't fight that. Well, let's go with one of the main beneficiaries of that, which is U Group. And we have a section of companies we think of as defensive growth companies. And amongst those are Gamma Communications. Some might call it a technology company. We really see it as a defensive growth quasi-utility company. It's providing telecommunications to a very large range of businesses. And again, with this one, even more extreme than any other one we see here, the sell-off relative to the earnings growth is quite extraordinary over the last 5 years. And that's why we're seeing some bid interest come into this company. Just today, they've announced a name of a PE firm that's looking at it. The investors have all given their feedback to the broker about what kind of price might be acceptable, but clearly quite a bit higher than the current price. I'd be sorry to see this one leave the market. It's been very well managed, and it's a neat company. It's a defensive growth business. Other examples of that, Mears Group. It's become one of our favorites here. And really, we were just in part responding to just a massive discrepancy between where the shares were and the strong growth in this business and the strong growth to come in this business. So it's really been executing incredibly well. I won't dwell on the details of it, but it's providing services mostly to governments and local authorities, key services. It's been had almost excessive earnings growth from being one of the 3 companies that provides asylum seeker accommodation services to government, and they've executed that very well. That's clearly going to be diminishing over the next few years, which is why that is reflected in the earnings growth flattening out to a degree from here. But the rating of the company is so low that that's more than compensating for that factor, and all the other parts of this business are growing very significantly. And then another interesting example, really, BTG Consulting, this is Begbie's Trainer, the insolvencies practitioner, does quite a lot of advisory services as well, corporate advisory services. You can see here over the last 5 years, really strong earnings growth, 0 share price performance. And we just think these are anomalies, and this is what all of us in UK small cap are just waiting for the market to find its feet again, where we'd expect these kind of things to just come back pretty quickly when it happens. And it's why you can speak to most UK small cap fund managers and they're going to say, well, there's a lot of potential in this market for some pretty strong performance to come as soon as we get a little bit of normality in the market and we start to see flows coming back into these kind of funds, money coming back into it. If it doesn't come from UK investors, it's going to come either from trade buyers, PE acquiring companies, or overseas investors, particularly US investors, who are really tend to be pretty consistent buyers of the UK market. So with that, Gregor, do you want to just come with some concluding remarks and we'll wrap it up?
Yes, that is the conclusion. I think that stock prices in the UK continue to trail the earnings growth, as those charts so starkly illustrate. I mean, in aggregate, the fund trades on 11 times earnings. It's a fund of UK listed growth companies, so that's about the same as the UK small and mid caps in aggregate. It's a huge discount to the US. It's a significant discount to Europe, and it's even a discount to UK large cap. And I suppose the evidence that represents value, well, that comes almost daily in takeover activity. Gamma, you've mentioned, has been bid for this morning. Intertek, a FTSE 100 company, agreed to a bid yesterday. Every week there are bids coming in for UK companies at significant premiums to the undisturbed share price, and quite often the managements are turning around and saying the bids undervalue the business. So that shows what they think of the prospects. And add into that the share buybacks. The companies take the profits, and the best return that they can see is to buy back and retire their own equity. Tells you what they think of the rating, and I think that gives us comfort that that we are in a universe where there's an awful lot of value left on the table.
Great, thank you. And with that, we'll wrap it up there. And thank you for listening. Thanks for supporting the fund or being interested in the fund. And please contact your sales representatives at Amati for any further information. Thank you.